Okay, so good evening and welcome to the fourth session of the lectures for economics for finance. In the morning, towards the end of the lecture, we were discussing the theories of money demand. Let me put things in perspective once again. The idea is that there are two types of policies that the government uses in order to affect the economy. One is the fiscal policy, which we have studied at length in the first session today in the morning. And the second type of policy is monetary policy. And monetary policy is the policy through which the government tries to affect the macroeconomic variables by altering the value of money supply and through that the rates of interest. So it is the rate of interest and the money supply that are important in monetary policy. And before we go to the issues of monetary policy, it is important for us to understand the determination of rate of interest. Interest rate is the price for money, you can say, and just as it happens in case of all the commodities in economics, the price of anything is determined by the demand and supply forces. And likewise, the interest rate is also determined by demand for money and supply for money. So we need to first study the demand and supply for money. That will give us an idea about how the interest rates are determined. So in the first lecture today in the morning, we had discussed 5 theories of demand for money. One is the quantity theory of money, the Cambridge version of quantity theory of money. Second is the Keynes theory of money supply. In the Keynes theory of money supply, we had studied 3 types of demand for money. One is the transactions demand. We need money because we need to make transactions. The alternative to holding money, that is bonds, which is the interest-bearing assets. Even though they give us positive nominal yield, they do not give a non-zero nominal yield, rather, they do not give us any interest. Okay, so if you want to make transactions, we need to hold money. The transactions rise as someone's income rises, and therefore the transaction demand for money is positively related to income. Similarly, precautionary demand for money, there are certain transactions that we may need to make, but about which we do not know in advance when we are putting money aside for making transactions. Okay, there are some unforeseen circumstances. Okay, we may need to purchase something about which we did not know in the beginning of the month. There may be some emergency in the form of some sudden disease. One may fall ill, one may have fever, and for that one may have to spend some rupees to consult the doctor, for instance. Okay, so these are precautionary motives. Third is the speculative demand for money. The speculative demand for money arises because the bonds have possibility of capital losses. As we have discussed, bonds have 2 types of return. One is the interest rate that they give you, and there are capital gains. Okay, and just as there could be capital gains, there could also be capital losses. And the capital losses sometimes can be so large that they can even be greater in magnitude than the interest being earned. And as a result, the overall yield on the bonds would be negative, while the yield on money is always positive. When there is a possibility of negative, when there is a high probability of negative yield on the bonds, it is better to hold everything in the form of money. And that is the reason we had seen in the morning that according to the Keynesian theory, when the bond prices rise above a threshold, so that one is almost certain that the bond price will definitely decline, that is, the capital losses are imminent, or which means that the interest rates are so low that one knows that yes, they will certainly rise, which would mean that the bond price will decline. So below such critical rate of interest, one will switch completely to money. Okay? The critical rate of interest, that is the rate of interest at which one would switch whatever one has into money, that critical rate of interest varies from person to person, and therefore what we have is a smooth looking money demand function, the way we saw in the morning. Let me show it to you once again. Okay. So this is what we have seen for an individual, and if we aggregate over all the individuals in the economy, we will get this type of money demand curve. Third, we had seen the demand for money. So according to the Keynes theory of demand for money, the money is a positive function of income level and the negative function of rate of interest. Third is the Baumol-Tobin transaction inventory theoretic approach to money, which we had seen suggests that the demand for money depends on the rate of interest. Higher is the rate of interest, higher is interest foregone in holding money in the holding wealth in the form of bonds or bank deposits, and therefore one would like to economize on money holdings. That is, money demand is a negative function of rate of interest. Secondly, money demand also depends on the transaction cost. For converting your bond holdings into money holdings, higher is the transaction cost, more bond money holdings we would like to have. Okay, so money is a positive function of transaction cost. Then we had seen the quantity theory of money by Milton Friedman. Let me write it here. We had seen that according to the Cambridge approach to Cambridge approach to quantity theory of money, money demand is equal to K P Y. Milton Friedman makes one correction. As I said, Milton Friedman's theory was simply a restatement of quantity theory of money, and there was a difference. Milton Friedman discusses the factors which determine the parameter K. It includes rate of interest, your inflation, at least, and there are other things which return on other assets. Okay, so when either of them rises, when the rate of interest rises, return on equity rises, on the inflation rises, money holdings decline. Okay, but please note again that it is a negative function of rate of interest, and of course this income level there is the permanent income level, as we had discussed in the morning. Okay, then finally we had studied the Tobin's portfolio approach. The idea here is that even though bonds give you money, bonds give you positive nominal yield or non-zero nominal yield, this comes with a risk. So even if the rate of interest is above the critical rate of interest, the capital gains are not certain. There is a risk involved. So one would not still put everything in the form of bonds. One would choose optimal combination of risk and return. And therefore, unlike what Keynes said, that an individual will hold everything in the form of bonds, or either completely in the form of bonds or completely in the form of money. In real world, one holds both money and bonds because there is risk involved, and one chooses an optimal combination of risk and return. Let me just open the questions once. Okay. So what one can conclude from all these theories is that money demand is a function of interest rate and income level. That is one major conclusion that comes out almost from every theory, and as a result, which means if you draw money demand against rate of interest, you will get a negatively sloped money demand curve. So here I am measuring rate of interest. Here I am measuring one will get this type of relation. Okay, this is the money demand curve. Okay, here I am measuring rate of interest, and here I am measuring here I am measuring R, and here I am measuring money. Okay. Next, we move on to money supply. Now, money supply, let's first discuss what money supply, how it is determined. Now, for that, as I had said in the morning, that money supply these days is defined as a set of financial assets, liquid financial assets. Financial asset, which is an asset to us, is a liability for some financial institution. And here we keep ourselves confined to liabilities, financial liabilities of some particular set of financial institutions, which are said to be money creating institutions. These money creating institutions are of two types. One is the central bank of the country, and other are banks, commercial banks, cooperative banks, etc., which is collectively called the banking system, or which satisfies the definition of something called depository institution as defined by the International Monetary Fund. Okay, so first we look at the money supply measures in India. Now, once we say that, let me be more specific and say that money supply as we understand is given by sum of two factors. A, the currency with the public. So M is given by currency with the public plus deposits with the banking system. Okay, currency, public plus deposits with the banking system. This is what total money supply is equal to. Now the question is, what type of deposits? We broadly distinguish between two types of deposits. A, demand deposits, which are withdrawable on demand. And then there are time deposits, which have fixed term. And if you are withdrawing them before the end of the term, then there is some penal provision. There is some penal provision in terms of the foregone rate of interest. Okay. So whether we keep ourselves confined to demand deposits or time deposits, that is the issue. If we are including only demand deposits, then that is called the narrow money. So we can say narrow money is equal to currency plus demand deposits plus demand deposits. But this, if we also include time deposits, that is, we have currency plus demand deposits plus time deposits, then we have something called broad money. That is the basic idea, broadly accepted definitions for these two types of monetary measures. Now let's come to the aggregates, monetary aggregates in India. In India, we first started compiling money. The Reserve Bank of India, as you know, was established in 1930s, and it started publishing the data for money supply right since then. But at that time, it was just publishing data for C plus DD. Okay, that is called the measure of money supply, which we now call narrow money. In mid-1960s, early 1960s, one working group was set up to study the money supply issues in India. That is called the first working group of the Reserve Bank of India for money supply. And that suggested that we should also have an additional measure of money supply, which includes, apart from the demand deposit, something called the time deposits. In that, they suggested it should be called the aggregate monetary resources. It should have C plus DD plus TD. Okay, so this was introduced in mid-1960s. Then in 1977, there was second working group of Reserve Bank of India was set up. Second working group of RBI on money supply was set up under the chairmanship of Dr. S.L.M. Simha. This working group suggested four monetary measures: M1, M2, M3, and M4. M1 is nothing but your narrow money, broadly. M3 is nothing but your broad money, as we have discussed above. And of course, apart from currency and deposit and time deposit, there is another category called other deposits, which is a small category, which is discussed in your book. I'll not go into details of that. Okay, but broadly it is currency plus demand deposits, and currency plus demand deposits plus time deposits. But then Reserve Bank, this group also suggested another measure called M2. This included, apart from M1, the demand liabilities portion of Post Office Savings Bank. And this was done for the reason that in 1960s, savings deposit at the Post Office Savings Bank. This was done because at that time, the penetration of banks to the rural areas of the country was not that large, and as a result, banking services to rural areas in particular of the country were provided by the post office. So M2 included this, and M3 included M4 plus time deposits of the Post Office Savings Bank. So 77 onwards, we had 4 more aggregates: M1, M2, M3, M4. Of course, as I said, I'm omitting the other deposits. That is understood, but that needs to be kept in mind. Okay, it includes strictly other deposits as well. Then in 1997, the Reserve Bank of India suggested the third working group on money supply under the chairmanship of Dr. Y.V. Reddy, who was then the Deputy Governor of RBI. This working group suggested a few important changes. The measures are listed in your book. I'll not go into details of that. First, it said this: the post office deposits should not be a part of monetary aggregates. Okay, because post office, these do not satisfy that these are not a part of the banking system. So, and according to the International Monetary Fund Manual on Financial Statistics, Monetary and Financial Statistics, only the institutions which are in the nature of depository institutions, only those liabilities of those institutions should be included. So, therefore, post office should include, and therefore, there are certain operational issues in including the post office deposits, which I cannot discuss here. But these are discussed at length in the report of the third working group. I think extracts from which are available in public domain. And of course, this report of third working group was published along with the RBI Bulletin of June 1998. So available in public domain. The other suggested measure was that the suggestion that is relevant here is that M1 includes the savings deposit. Now, in order to say that, in order to distinguish, to talk about this another measure that RBI suggested, let me talk about what constitutes time deposits and demand deposits for the Indian banking system. I hope you know very well that in the Indian banking system, we have mainly 3 types of deposits. One is the current account deposits. These are completely demand deposits. Then we have term deposits, which we call FDs in general language. These are completely time deposits. And third is the savings account deposits. These are both demand deposits plus time deposits. And this bifurcation is done on the basis of eligibility. That part of your savings account deposits which earn interest are classified as time deposits, and the remaining part which does not earn interest is called the time deposit. As you know, you earn interest only if the principle of application of interest you know very well. If it is calculated on the daily basis. Suppose you deposit something in the morning and withdraw in the afternoon, it will not be counted for interest application. So the part which earns interest qualifies as time deposits, and rest is demand deposits. That is first thing. So savings account deposits have both the parts, demand and time. Secondly, term deposit could be for 7 days, it could be for 5 years. Okay. So Reserve Bank, so this third working group suggested that we cannot treat all the time deposits equally. there is a difference in the motive of holding a 7-day deposit, 6-month deposit, 1-year deposit, and a longer maturity deposit. So they say we should bifurcate the term deposits into two categories: maturity up to 1 year and maturity more than 1 year. And that is the reason they suggested we should introduce another measure, M2. By the way, the measures suggested are M1, M1, and M2, and M3. NM1 is broadly, let me say, broadly the same as old M1. NM3 is broadly the same as NM3. NM2 is your NM1 plus term deposits with maturity up to and including 1 year. Okay, again, time deposits with the banking system, not with the post offices and other institutions. Okay, and time deposit with maturity up to 1 year means, this means the time portion of savings accounts plus up to and including 1 year. Okay, so these are broadly the measures. Then the other measure that is suggested was India's financial sector had undergone sea changes between mid-1980s to the time when the third working group was suggested. So this means there were several types of financial instruments introduced. There were several types of financial institutions which came up. And as a result of that, the financial sector was completely much different from what it was at the time of the second working group. And that was one reason why this working group was set up, in the light of the new picture of the financial sector. So there were several types of financial institutions which provided services, deposits, facilities similar to that of the banking system. But the international best practices on this, and just as yesterday we had seen that the national income accounts are prepared according to the system of national accounts given by the United Nations. Similarly, the monetary aggregates have to be in conformity with the manual on money and monetary and financial strategies prepared by the International Monetary Fund. And according to that manual, only the liabilities of the depository institutions in India, it is just the banks which broadly satisfy the requirements of a depository institutions. So only liabilities of these institutions should be included under the monetary aggregates. But then the issue is there are other institutions, non-banking financial companies, which provide services similar to that of banks. But going by this definition, liabilities of those institutions cannot be included under the monetary aggregates. But since their deposits can also be withdrawn and it can be used, they also provide include liquidity. So what to do? So between not including them and their being useful for making transactions the way money is, the Reserve Bank chose to define a set of separate aggregates, separate from the monetary aggregates. These are called liquidity aggregates. So these liquidity aggregates, there are three aggregates: L1, L2, and L3. These liquidity aggregates include the liabilities of non-banking financial institutions, okay, which provide services similar to the banking institutions. So for instance, L1 includes NM1, P plus liabilities of the post office savings bank, and similarly L2 and L3 include liabilities of the other institutions. So this is broadly the aggregates that are discussed in India. The next question is that of determination of money supply. How is money supply determined? That is the next question. Now, here we will discuss just one theory of money supply determination, that is the money multiplier approach. And after I discuss that, let me also tell you that Reserve Bank of India third working group, in the list of aggregates that need to be compiled, it had before M1 and M1 and M3, it had something called M0 and M0, the reserve money. Okay. Now I can talk about NM0, the reserve money. I hope you have all studied the fractional. You are all familiar with the idea of fractional reserve banking system. So I'll not discuss that in detail because that is important in understanding the money multiplier approach too. Okay, so reserve money basically is the money that the central bank makes available. The money that is given by the Reserve Bank of India, it is printed by the Reserve Bank of India, that can be used in two forms. Okay, the money that is given by the Reserve Bank of India is called the reserve money, or high-powered money, or base money. This money can be kept in two forms. A, currency with the public. B, reserves, bank reserves. The reserves which the banks keep either with themselves or with the Reserve Bank of India. I hope you have all studied fractional reserve banking system. Please listen to this. Even if you have not studied it or if you have do not remember it that clearly, listen to this discussion very carefully. The idea is the following. Suppose you get rupees 100 from the Reserve Bank of India by selling a security to the Reserve Bank of India. Okay, what will you do? You would like to keep a part of this with yourself in the form of cash. Suppose you keep 10 rupees with yourself in the form of cash and you deposit 90 rupees in a bank. Okay, what will bank do with this? Banks are not supposed to keep entire thing with themselves. What they do is they will keep 10 rupees with themselves as a reserves or whatever reserve they want to keep and loan away the rest. So suppose this bank keeps out of this 90 rupees, 9 rupees with itself and loans away rest 81 rupees. The person who has taken this loan will keep part of this as cash and deposit the rest with another bank. The other bank will again keep some proportion as reserves and then loan out the rest. In this process, what will happen? The total amount of deposits created will be much larger than the initial money that you put in, that you had got from the central bank. Okay, where will it be found? It will be found either by in the form of cash that you are holding, it will be found in the form of reserves that the banks are holding. Okay, but given this, just imagine you have 100 rupees worth of, because you are holding 90 rupees as deposits and 10 rupees as cash with yourself. So your money holding is 9 plus 90, 900 rupees. Look at the other person, that person who has taken a loan of 81 rupees from the bank where you put your deposits. Suppose that person out of this 81 rupees, suppose keeps 8 rupees with itself and deposits 72 rupees with 73 rupees with the bank. Okay, the person has this entire amount of 81 rupees as money, because the person is holding part as cash and part as deposits with the bank. It is the liability of that bank. Okay, deposit liability of the bank. So your 100 rupees plus 81 rupees of the other person. Similarly, the person who will be getting loan from this bank, where this person is depositing 81 rupees, 3 rupees, will again keep a part as cash and keep a part as deposit. So the 100 rupees that you had received from the central bank will lead to multiple deposit creation or multiple credit creation. So this process of fractional reserve banking system, through this we have multiple deposit creation and credit creation. As a result of this, the total money supply, which is equal to C plus deposits, is much larger than the high-powered money, which is what also called the central bank money. Okay, we can express this as M is equal to M times H, where this M is called the money multiplier. Basically, this gives you the ratio of M by H. Okay. Now, we have already studied what is the process of money multiplier. Okay, so we can easily understand what are the factors which determine the money supply on the basis of the discussion that we have held so far. First of all, it is you can see there are three parties involved in this process of creating money. One is the central bank. Other is the banks. And third is the public. Let's, for 1 minute, go through the process of deposit creation. You get something from the central bank. You keep a part as cash, deposit the rest with the bank. Bank keeps us a part as reserves, loans out the rest. Okay, it should be clear that this money supply, if you choose to hold a larger fraction of whatever you received as currency and accordingly put a smaller fraction into the bank, the amount of funds that you are putting into the bank and therefore which is enabling the bank to create multiple deposits will be less. So if you are holding large amount of currency, the money supply total generated by the given amount of high-powered money will be less. Number one. Number two, look at the bank. Bank is putting some reserves. If we have assumed that out of this 90 rupees that you are putting into the bank is keeping just 9 rupees. Suppose bank decides to keep 18 rupees. Bank will be lending just 72 rupees then. So instead of 81 rupees deposits being created and 82 rupees being the money supply, money for the other person will be only 72 rupees. So the reserves that the bank is keeping, that also is another parameter. Reserves are of two types. There are some mandated by the central bank, in this case Reserve Bank of India. Others are excess reserves that the banks have to keep. Larger is the reserves that the banks keep with themselves. Smaller is the money creation. So money multiplier will be smaller. So we can say money multiplier depends on the following factors. Money multiplier rises with money supply. This money multiplier, let me write it right here, is a function of and also reserve ratio. Reserve ratio is of two types, required by the central bank and then some excess reserves that banks keep. Excess reserves are kept by the banks because just to honor the demand for withdrawals. If someone goes to the banks to withdraw cash, and if the bank doesn't have cash, then obviously the bank will be in trouble. It will create confidence problems about that. People's confidence in the bank. So the problems for that. So bank has to keep some excess reserves for that. Okay, so now we can discuss the factors which the central bank determine the money supply. Central bank controls money supply through two channels. One is the high-powered money. If the high-powered money is large, money supply will be large. It should be clear to you. How central bank creates high-powered money, I'll come to that when I discuss monetary policy. And second, it controls the RR, that is the required reserve ratio. If the required reserve ratio is large, then rate inflation will be less, and therefore money supply will be less. Okay, so Reserve Bank can control through two channels. Second is the banks. Banks control it through excess reserves. That is, excess reserve ratio. Why would banks like to keep excess reserves? We have already discussed why banks would like to keep excess reserves. Banks would like to keep excess reserves because they would like to honor the withdrawal demands. Okay, what are the factors that determine the excess reserve ratio? If the interest rate, now if the interest rate on loan is very large, if the interest rates on loans is very large, then the opportunity cost of keeping excess reserves is large. Banks are foregoing larger interest by keeping excess reserves. They would like to economize on excess reserves. First thing. Then, if the banks do not have excess reserve and there is some withdrawal demand, they can borrow from the market. They can borrow from the central bank. If the interest rates on borrowed reserves are large, if the interest rates on borrowed reserves are large, then banks would not like to borrow from the central bank or the market, and they would like to keep their own excess reserves. So that is another factor. Third factor is uncertainty. When there is an atmosphere of uncertainty about the ability of people to repay the loans, then it's a problem for the bank. If banks are living in an atmosphere when they fear that the loans probability of being repaid is not known to be very high, then instead of extending loans, they would like to keep the reserves with themselves. So higher uncertainty leads to higher excess reserves, and higher excess reserves means lower money multiplier. Finally, probability. If banks expect people to withdraw money, withdraw cash, in that case they would like to keep more deposits. So these are the factors which determine excess reserves. Finally, public controls currency to deposits ratio. As we have seen, if the currency deposit ratio is large, then the deposit creation with the given high-powered money will be lesser. Therefore, money multiplier will be smaller. One interesting factor that emerges out of our discussion is, unlike what we get to hear in the common discussion that the money supply is controlled by the Reserve Bank, please note Reserve Bank is just one out of three parties which can control money supply. Money supply can be controlled apart from the Reserve Bank by the banks through the excess reserves and by the public through the currency deposits ratio. Okay. Before I come to the end of this topic, let me give you a formula for the deposits rate, the deposits multiplier. It is given at the end of your book. It can be derived directly using the formula that we have just discussed. If we can assume that people do not keep any cash with themselves, in that case it can be shown that total credit is equal to 1, assuming no excess reserve, divided by We have seen that larger is the required reserve ratio, smaller is the extent of credit created. It can be shown that if required reserve ratio, if there is no cash being kept by people, credit is equal to 1 by required reserve ratio. Okay. So this is credit multiplier. That means credit is equal to the total high powered money divided by required reserve ratio. Okay. So let me talk in terms of this. If required reserve ratio is 10%, credit multiplier will be 10. If required reserve ratio is 5%, that is 0.05, you can understand credit multiplier will be 20. Before I finish this topic, let me do a numerical question. These data I have taken from the RBI publication for, and these pertain to some week in the middle of March last month. We are given these data. The data currency with the public is equal to this 22187. Let me enlarge it. I hope now it is clearer. It is given that currency with the public is this much, demand deposits is this much in rupees billion, demand deposit is this much, time deposit with the bank is this much, and the other deposits with the Reserve Bank is this much. So as you can see in the formula given in your book, my M3 is given by currency with the public plus demand deposit plus time deposit plus other deposits. If you add these four, you will get this value. Okay. Let's do an exercise for reserve money. M0. Again, these data I have taken for the same week from the RBI. Currency in circulation is this much. Bankers' deposits with the RBI, the reserves, is this much. Other deposits with the RBI is this much. And if you add the three, high powered money turns out to be equal to this. And to give you a practical idea, this is the size of high powered money in India as of middle of March 2020. Okay, roughly rupees 29,000 billion. That is roughly rupees 29 trillion. Yesterday we talked about stock and flow variables. Flow variables are measured for a given period of time, like income. Stock is measured at a point of time. So as on, I guess roughly it is 15th of March. As on 15th of March, actually these data are released by the RBI every week. So the data release pertain to end of the week, so Friday. So we can say as on the second Friday of March 2020, the Reserve Bank, the high powered money in India was this much. On the other hand, M3 was equal to this much. And in fact, with the help of this, you can calculate the value of money multiplier. Money multiplier M is equal to M3, which is equal to this divided by let me copy this here. This is M3. So M will be equal to M3 divided by this. That means the value of money multiplier for India is close to 5.6. Every 1 rupee that uses will give rise to roughly 5 rupees 60 paise in terms of money supply. That is what it means. I hope this is clear. Finally, let's come to the issue of monetary policy. have already discussed what money supply. What is money supply? Monetary policy. Monetary policy is basically the policy of the central bank through which the central bank affects the desired variables in the macroeconomy through the use of money supply and interest rate, etc. Okay. We need to discuss 3 or 4 things in monetary policy. First is the objectives of monetary policy. What are the objectives of monetary policy? Now, the objectives of monetary policy change over time in the same country, and of course, these are different across different countries. Even within India, the objectives of monetary policy have undergone major changes, at least during the last 30 years or so. If you look at the RBI Act does not specify clearly what the objective of monetary policy in India is to be. Of course, now it was amended in 2016, and then the price stability was made an explicit objective of monetary policy. But initially, it was not. Okay, so in the real world, we find many types of objectives of monetary policy. So, in terms of objectives, the RBI Act clearly does not specify anything, but it basically is meant to ensure at least 2 things: A, price stability, and adequate flow of credit to the productive sectors of the economy. Okay, that has been broadly the set of objectives that RBI has followed. In early 1990s, we started opening up our financial sector. We started liberalizing our financial sector within India, and we also started opening it to the rest of the world. Okay, and as a result of that, the financial system started facing fresh challenges from inside as well as from outside, and gradually financial stability also became an objective. In mid-1990s, the Reserve Bank of India started something called the multiple indicator approach, in which it was targeting a large number of indicators together. For instance, credit to the productive sectors of the economy, long-term interest rates, exchange rate, external balance of payment equilibrium, economic growth, large number. This is called a multiple indicator approach. Then in 2016, Reserve Bank of India Act was amended, and Reserve Bank of India was given the mandate to target inflation. So we now have something called flexible inflation targeting, so that the inflation rate has to be a specified band. This band is to be determined for a period of 5 years. In 2016, this band was determined to be 4 plus minus 2%. So the inflation rate as measured by CPI combined, that means CPI rural and CPI urban, this inflation rate has to be within 4% plus minus 2%. That is 6%. It has to be between 6% and 2%. That has been made an explicit target of central bank's policy. Okay, but then within this band, it can vary looking at the emerging macroeconomic scenario. Okay. Finally, let me highlight one important problem that arises with the in the policy. There are some instances when there might be some conflict between 2 or 3 objectives. Let me talk about one recent episode and one slightly older episode. Recent episode. Almost throughout 2019, India was grappling with both high inflation. Inflation was about 5-6% for many months, and low growth. Low growth required reducing rate of interest. High inflation required raising rate of interest. There was a conflict between the two. Okay. Another example we faced in 2013 June. At that time, the Federal Reserve in the United States had indicated that it will start raising the rate of interest. And for the reasons that will become clearly in the next topic, when we discuss the open economy, when the international trade, the exchange rate, etc., I'll try to spend some time on that. This required raising rate of interest. On the other hand, economy was not performing so well, so that required reducing rates of interest. So there was a trade-off involved here, and the Reserve Bank had to was facing a trade-off. So at times there are conflicts between the different objectives of monetary policy. Now let me come to the channels. Monetary transmission mechanism is the mechanism through which the actions of the Reserve Bank affect the target variables. There are 4 channels that we discussed here. One is the interest rate channel. Interest rate channel is the following. Let me take you to this diagram. We have discussed this money demand, and then let me introduce money supply here. This is money supply. Okay, we have drawn it vertical. You can note as the interest rate, as the money supply rises, interest rate declines. Okay, if the money supply rises to this curve, you can see the interest rate has declined. Okay, so as money supply rises, interest rate declines. Now, as the interest rate is declining, we have seen that interest rates are lower. If the interest costs are lower, firms have an incentive to invest. So, lower interest, firms can invest. Lower interest, higher investment. Similarly, lower interest, consumers can take loans and they can buy things such as houses and automobiles, and things like many people even buy consumer goods using loans like refrigerators and other things. Okay, so that way lower interest rate will mean higher consumption, higher investment, accordingly higher aggregate demand, and therefore higher output. So that is one channel. The second channel is the exchange rate. Exchange rate, I cannot say much as of now. I'll say towards the end of my lecture. Or exchange rate is the price of the foreign currency in terms of domestic currency. If the price of domestic currency in foreign currency in terms of domestic currency rises, which we call exchange rate. So, for instance, as of today, the price of dollar in terms of rupee is close to rupees 76 per dollar. Okay, if that is rising, it is making our exports cheaper as compared to imports. Okay, so in the foreign country, it will make our goods cheaper as compared to their goods. Okay, and in domestic country, in India, it will make our goods cheaper as compared to their goods or imports. So as a result, the demand for our products will rise at home as well as abroad, and therefore aggregate demand rises. That means our X minus M, net exports rises. As if exchange rate rises, net exports rise. If aggregate demand rises, so that is another thing. Third thing. There are 2 channels which are collectively called the credit channel. One is the bank lending channel. Bank lending channel. Bank lending channel basically means that if the central bank is following tight monetary policy, in that case, the banks will cut down on their lending. Okay, it becomes difficult for them to if look at, for instance, Reserve Bank of India is raising the required reserve ratio. There are fewer funds available with them for making loans. As a result, they will cut back on lending. So it is one channel. The other channel is that of balance sheet channel. If the interest rates are higher, one effect is we have already seen the interest that the firms have to make on their loans will rise. It will lead to worsening of the balance sheet, and we have seen it means higher cost of borrowing, so they will reduce their investment. That is one thing. There is another thing. They have their own investments, so they are going to receive the return for that. Okay. You have seen in your finance courses that the value of any asset is equal to present discounted value of the cash flow. And the present discounted value is determined by the rate of interest. As the rate of interest, that is the rate of discounting, rises, the value of that asset declines. So it means if the rate of interest is rising, which is what happens when the central bank goes for tightening of monetary policy, making credit more expensive, in that case, the values of banks' assets decline. Values of banks' assets decline. We already know that values of their liabilities rise. So that means the value of institutions' net worth declines. As you know, if banks' net worth, if institutions, firms' net worth declines, it becomes more difficult for them to take loans. Okay, as a result, they cannot make investment. It becomes difficult for them to make investment. So this is called the balance sheet channel. Finally, asset price channel. Again, if we have seen that the price of an asset is equal to present discounted value of the cash flow. Same is true for equity also. So if the central bank is tightening monetary policy, interest rates are rising, it will lead to declining stock prices, for instance. As stock prices decline, it affects consumption as well as investment. In finance, you must have studied the Q theory of investment. Broadly, it says that as the stock prices decline, investment made by the firms declines. Secondly, the consumption depends on wealth also. The more wealth you have, the more consumption you make. As stock prices decline, people's wealth declines, they reduce their consumption. So, consumption declines, investment declines, which means decline in asset prices lead to decline in aggregate demand. So, there is another channel. So, there are 4 channels of monetary transmission. Finally, let me come to the operating procedures of monetary policy. Operating procedures is basically about the action, what are the variables that the central bank affects. Okay, and when taking the action, what are the variables that the central bank targets. Now, your book has some discussion, but let me, keeping it aside for a while, let me talk about 2 or 3 concepts. One is a variable which the central bank chooses, that is called the operating instrument of the central bank. Then there is a variable which the central bank targets, okay, while deciding how much to change. Okay, that is called the operating target. Okay, then there is something called the final target. We have already seen the final target. Final target, this is inflation. Okay, it has to be within 4 plus minus 2. That is the final target. Then operating instrument or instrument of monetary policy. We need to understand 2 things. And operating target of monetary policy. Operating target of monetary policy is the target the central bank keeps in mind when it conducts the monetary policy operations on a regular basis. This operating target as of today, India is the weighted average call-money rate. Call-money rate is the interest rate in the interbank market, overnight market for overnight funds. Okay, the shortest term rate of interest. Okay, this is what the Reserve Bank targets. So it is very high. It gives an indication to the Reserve Bank of India. The interest rate is very high in the economy. There is tight liquidity condition. So Reserve Bank has to increase the flow of liquidity into the market. If it is very low, it gives an idea to the central bank that interest rate is very low. Money is in surplus, so it needs to reduce the liquidity in the market. Okay. Come to the instruments of monetary policy. There are instruments. One is the cash reserve ratio. We have already discussed what cash reserve ratio is and how it is important. All I would say at this stage is that cash reserve ratio is treated as a blunt instrument of monetary policy because it affects all the banks whether they have surplus liquidity or not. Okay, so it is used very rarely these days. There is a statutory liquidity ratio. Statutory liquidity ratio. This statutory liquidity ratio is about, while this is about keeping this cash reserve ratio is about keeping the of India, statutory liquidity ratio is about investment in specified securities. For instance, it is in golds, government securities, and some other securities specified by the Reserve Bank of India. Your book contains a list of the instruments which are eligible. I will not go into details of that. The third is open market operation. Open market operation, that means sale or purchase of government securities. It could be other securities, but mainly it is government securities. In the open market. When central bank is selling securities in the open market, that means it is selling securities, it is absorbing liquidity. If it is purchasing securities, it means it is injecting liquidity, because if you are purchasing securities, then obviously you are giving central bank money in return, no? Injecting liquidity. Okay. So to this, central bank can purchase, or the advantage of open market operations over cash reserve ratio is that only those banks will participate in this purchase or sale who need to, not everyone. One type of open market operation is the repo operation. Repo is repurchase agreements. You are selling, or the other party is selling to RBI suppose one party is selling a security to the RBI. Suppose you are a bank and you are selling a security to the RBI with a promise with an agreement to repurchase it. That means you are selling, you are getting liquidity from the central bank. Okay, and at the same time there is an agreement for repurchase of it. So you are telling central bank that okay, on this date I will repurchase my security. That means I will give you back. So effectively this repo agreement, central bank injects liquidity on temporary basis. This repos could be just the opposite of this is the reverse repo, and this is of course against the government securities, because you are selling the government security for temporarily. Reverse repo is just opposite of that. Central bank is against government securities. Okay, so in repo operation, central bank is injecting liquidity temporarily. Reverse repo, central bank is absorbing liquidity. These days, Reserve Bank of India's primary operating instrument is something called liquidity adjustment facility. LAF. Reserve Bank of India conducts repo and reverse repo operations on a daily basis. Okay, so repo rate is the rate at which repos are conducted. Reverse repo is the rate at which the reverse repo operations are conducted. Okay, reverse repo rate is tied to the repo rate. Okay, repo rate is the rate at which the banks are borrowing from the central bank. Reverse repo rate is the rate at which they are lending to the central bank on a temporary basis. If they have surplus liquidity, they can lend to the central bank. Repo rate is the rate at which they are borrowing from the central bank. Okay, so between repo rate and reverse repo rate, there is a corridor. There is another facility called the marginal standing facility. MSF. There are certain limits up to which the banks can avail the liquidity adjustment facility. If they still need more funds, they can borrow from borrow further from the RBI against government securities that over and above their entitlement to repo operations at an interest rate which is a few basis points above the repo rate. Okay, that is called the MSF rate. So going by this, it should be clear if banks need to borrow the funds, they can borrow at the repo rate, and if they need more, they can borrow at the MSF rate. If they have surplus funds, they can park with the Reserve Bank at the reverse repo rate. As a result of this, if you are in extreme case of need for funds, the market rate is very high, you can always go and borrow from the Reserve Bank at MSF rate. So that the call money rate, weighted average call money rate, will not exceed MSF rate. On the other hand, if there is surplus liquidity in the market, okay, you don't need to lend your funds at very low rate in the market. You can lend to the RBI at the MSF rate. So this MSF rate and reverse repo rate provide a corridor in which the weighted average call money rate can move in India these days. Okay, if you would recall, just last week the Reserve Bank of India reduced the reverse repo rate. Okay, why so? The Reserve Bank of India, by reducing the reverse repo rate, is making it unattractive for them to park their funds with the RBI. Okay, if they are, instead of parking their funds with the RBI, if they have surplus funds, use these funds to lend to the people, create more credit. So this is to, in a way, make it less lucrative for the banks to park funds with the RBI and make it more lucrative to instead extend loans so that economy, which is required to boost the economic activity at this stage. Earlier, towards the end of March, Reserve Bank had reduced the repo rate. Okay, the rate at which it lends to the banks. So that makes it cheaper for them to borrow from the Reserve Bank. Okay, these are just measures. If it is cheaper for them to borrow from the Reserve Bank, obviously in that case they will not need to keep that much excess reserves and they can make loans. So the idea is somehow to prod banks to make as much loans as possible so that people can borrow and they can start making investment and consumption. As you can understand, our economy is going into growth rate is declining. So the challenge as of now is to promote economic activity. Okay, create more credit, and that is why Reserve Bank is reducing repo rate as well as reverse repo rate. I hope this is clear. Finally, to close this discussion, let me very quickly talk about the monetary policy framework. Till 2016, the Reserve Bank of India's monetary policy actions were decided by the Reserve Bank of India governor. Okay, Reserve Bank of India has the monetary policy division, which is headed by a deputy governor in charge. According to the RBI Amendment Act of 2016, Reserve Bank, there is a monetary policy committee. So this monetary policy committee consists of 6 members. 3 members are from the RBI, 3 members are appointed by the central government, who have expertise in monetary policy and economics. 3 members are governor, the deputy governor who is in charge of monetary policy department, and 1 officer from within the RBI who will be nominated by the government of India, by the governor. And then there are 3 members who are appointed by the central government. Okay, these members, 4 members, are appointed for a term of 4 years. As of now, we have we have the governor and the deputy governor who is in charge of monetary policy, namely Dr. Michael Patra, and there is 1 officer, Dr. Janak Raj from RBI. These 3 are the members from the Reserve Bank of India, and then there are 3 experts, Dr. Ravindra Dholakia, Dr. Pamedu, and Dr. Chetan Ghate. They are members from by the government of India. They were appointed for 4 years in 2016. Okay, so their term is up to 2020. This monetary policy committee meets once every 2 months. Okay, and it discusses and then accordingly decides on the monetary policy action, which is then implemented by the monetary policy division of the RBI. Okay, I think I'll finish this discussion right here. If you have any questions, please do post this question. Let me see if you have any questions before I come to my next topic. Market stabilization scheme I didn't discuss deliberately because this is something I don't think that is that much relevant today. Market stabilization scheme actually, this scheme was instituted in around 2005 because at that time the Reserve Bank of the Indian economy faced huge capital inflows. When the Reserve Bank, there are capital inflows, I will discuss in the topic that I'm going to teach now. When there are capital inflows, it leads to pressure on the currency to appreciate. Okay, in order to counter these pressures, the central bank intervenes in the market and buy excess foreign exchange reserves. But as the central bank is buying excess foreign exchange in the market, it is releasing Indian liquidity in the market, as a result of which money supply rises. Which money supply, a very high money supply, can lead to inflation. The Reserve Bank of India needed some bonds with which it could absorb this excess liquidity. We have seen open market operations, and Reserve Bank of India sells government securities in the market to absorb excess liquidity. But at that time, the capital flows were so huge that the Reserve Bank of India had run out of government securities. So, Government of India instituted a new fund called Market Stabilization Fund, MSF. Okay, and this scheme was called Market Stabilization Scheme. The idea was that some bonds would be issued, Government of India bonds would be issued by the Reserve Bank of India, because Reserve Bank of India is a banker to the Government of India. Okay, that is one important function of the central bank. It is banker to the government and banker to the banks. Okay, you must have studied in your 12th class economics course. Anyway, so at that time, this fund was instituted, and the idea was that whatever funds you are collecting by selling these bonds, these will be used just to retire these bonds and for no other purpose. This scheme of issuing Government of India bonds just to absorb the excess liquidity, which had been generated by the Reserve Bank in the process of buying the excess capital flows from the market. That is called the Market Stabilization Scheme. I hope this is clear. This is on the question about a Market Stabilization Scheme. Stock and flow, the idea is stock variables are those variables which are measured at a point of time. So what is the total credit outstanding in the Indian economy as of today? That is the stock. That is a stock variable. Flow variables are those variables which are measured for a period of time. Okay. Apart from that, I think then there is a question about cash reserve ratio and statutory liquidity ratio. Cash reserve ratio is the proportion of their deposit liabilities which they need to keep with the Reserve Bank of India. Okay. Statutory liquidity ratio, which needs to be kept in terms of a specified list of securities like government securities, etc. Both of them have one thing in common. Both of them sort of reduce the bank's ability to create credit. There is one question about whether the IPO of IRCTC is open market operation. It is not. Open market operations are conducted by the RBI. Okay. Liquidity adjustment facility is used by the RBI. Liquidity adjustment facility is just a facility through which the Reserve Bank of India conducts repo and reverse repo operations on a daily basis. Okay, so under repo operations, it injects liquidity temporarily into the banks. The banks can borrow from the RBI against the government securities under liquidity adjustment facility and repo operation. Reverse repo operation under liquidity adjustment facility, they can park their funds with the RBI for on overnight basis. Okay, so that is liquidity adjustment facility. Liquidity adjustment facility is basically repo and reverse repo operations conducted by the RBI on daily basis. Okay, that is the idea. Repo, reverse repo. And if banks still need liquidity beyond what they can get by the repo operations, they can get through marginal standing facility. So three things: repo, reverse repo, and MSF. Reverse repo, lowest rate. This is the rate at which banks can park their funds with the RBI. Liquidity adjustment MSF rate is the rate at which highest rate at which they can borrow from the center. Okay, let me quickly move to the idea of the topic on the third topic, that is international trade. Why international trade is desirable, etc. Those things I'll skip because these are descriptive stuff you can read. I will come quickly to the theories of international trade. First theory is about mercantilism. Mercantilism, according to mercantilism, the power of nation is reflected, the power and wealth of a nation is reflected in the stock of bullion that it holds, precious metal. Okay, and that you accumulate by running trade surplus. The more you export and less you import, larger is your trade surplus. When you're exporting, you're getting precious metal, which was called specie, SPIC, specie. That is precious metal. Okay, so you should export as much as you can, because that way you will be collecting precious metal. They also said that the more, if you are in a trade surplus, you will be collecting precious metal. If you are in a trade deficit, you are losing precious metal. So it's a zero-sum game. That means your gain is your partner's loss. If you are gaining, your partner will definitely lose. That was the idea. Adam Smith, for the first time, you must have heard, Adam Smith is said to be the father of modern economics. He gave a theory of absolute advantage. He said it is not a zero-sum game. He says both the parties gain through trade. Okay, and to show how the two parties gain, let me take you to this example, which I have taken directly from your book. But just to make it clear, I've done some calculations, which are again based on what is given in your book. To save time, I have these calculations here. Look at this panel. Adam Smith talked about labor theory of value. Value is created by labor. So he said that it is possible that one country has comparative absolute advantage in production of one commodity. Okay, so a country should produce that commodity in which one has advantage. And mutual trade is gainful for both the countries, mutually gainful. How? Let us see. This example I have taken directly from your book. This is table 4.1.1 from your book. So there are two countries, country A and B. The productive labor is measured in the bushels of wheat that it can generate in 1 hour of labor, and the cloth. Suppose there are both these countries only produce two commodities each, wheat and cloth. Okay, A can produce 6 units of wheat and 4 units of cloth, and B can produce 1 unit of wheat and 5 units of cloth. Now please be clear about this. Wheat, country A can produce more, B produces less. A is producing 6, B is producing only 1. Okay. On the other hand, cloth, A is producing only 4 and B is producing 5. So for cloth, in 1 hour, B is producing more cloth and A is producing more wheat. This is what Adam Smith called absolute advantage. And Adam Smith said both the countries will gain from mutual gainful trade. How they will gain? To give an example, just look at this first. For country A, 6 units of wheat is equivalent to 4 units of cloth, because both of these represent equal amount of labor being used. But for country B, 6 units of wheat are equivalent to 30 units of cloth, because the amount of labor required to produce 6 units of wheat, that will produce 30 units of cloth for country B. Okay, and it can be shown that if they exchange 6 units of wheat for anything between 4 to 30 units of cloth, it will be mutually gainful to both the countries. How? Let us take one example first. Let's see. They decide to trade in the ratio 6 to 6. That means 6 units of wheat being traded against 6 units of cloth. Look at this example carefully. If A is getting 6 units of wheat against, if you are trading 6 units of wheat against 6 units of cloth, what will happen? Against 1 hour, against 6 units of wheat, that is 1 hour worth of wheat, country A is getting 1.5 hours worth of cloth. Because for 6 units of cloth, country A will have to spend 1.5 hours. So it is gaining cloth worth half an hour worth of labor. Okay, so against 1 hour worth of wheat, it is gaining half an hour worth of cloth. That's a gain to the country A. Look at country B. Against 6 hours of wheat, it is getting 6 hours of cloth. It can get 6 hours of wheat. 6 hours of cloth it can produce only in 1.2 hours, because it is producing in 1 hour, it is producing 5 yards of cloth. So 6 yards of cloth it can produce in 1.2 hours. But against that, it is getting 6 hours worth of wheat, because this 6 units of wheat it will be able to produce only in 6 hours, which is huge. Okay, so just against 1.2 hours worth of cloth, it is getting 6 hours worth of wheat. Okay, so it is gaining 4.8 hours of wheat that way. Just imagine, only 1.2 hours of cloth against 6 hours worth of wheat. 6 hours is huge as compared to 1.2. So it is gaining 4.2 hours worth of wheat. Okay, that is one thing. Second thing, the closer is this, we have discussed 6 to 6. 6 units of wheat is equivalent to 4 units of cloth for country A, and 6 units of wheat is equivalent to 30 units of cloth for country B. As long as 6 units of wheat are being traded against anything between 4 and 30, it is mutually gainful to both the countries. But the closer is this cloth against 6 wheat, the closer is it to 4, the more gainful is it to country B, and the closer is it to 30, the more gainful is it to country A. It will also clarify this further, and it will also make this point clear. Let me therefore take another example. 6. I have seen 6 to 6. 6 to 6 is closer to 4. 6 to 4. Now let me take 6 to 24, which is closer to 6 to 30. In 6 to 24, what is happening? 6 wheat is equivalent to 1 hour of labor for country A, and 24 cloth is equivalent to 6 hours of labor for country A. So, for 1 hour of labor, it is getting 6 hour worth of cloth. 6 means 6 hours worth of cloth. Against 1 hour worth of wheat, country A is getting 6 hours worth of cloth. Okay, so that's a gain of 5 hours. Please note, in this case, the gain was only half an hour of cloth. Now it is 5 hours of cloth. It's closer to this. On the other hand, look at country B. 24. It is producing 5 yards of cloth in 1 hour. So 24 yards of cloth will be produced in 4.8 hours. Against 4.8 hours of cloth, it is getting 6 units of wheat, that is 6 hours worth of wheat. Against 4.8 hours worth of cloth, it is getting 6 hours worth of wheat. Again, it's a gain of 1.2 hours. Okay, but compared to this, here the gain for A was half an hour worth of cloth. Here it is 5 hours worth of cloth. It is more, much more. On the other hand, for country B, here the gain was 4.8 hours worth of wheat. Here it is only 1.2 hours worth of wheat. So the closer this ratio is to 6 is to 30, more is the gain to A. Closer this is to B. This ratio, more is the gain to country B. Okay. In this example, it would appear that the trade is mutually gainful to the countries only if one country can produce more of the commodity. Okay, this situation where each country can produce more of one of the commodities is called the theory of in that case they are said to have absolute advantage. Country B can produce more of cloth. So we say country B has an absolute advantage in cloth. Country A can produce more of wheat in 1 hour. We say country A has absolute advantage in wheat. David Ricardo said that it is possible to have mutually gainful trade even if one country has absolute advantage in both the commodities. In the situation where one country has absolute advantage in both the commodities, despite this, mutually gainful trade is possible provided there is difference in the extent of absolute advantage. If there is a difference, we say absolute advantage in one commodity is more as compared to the other commodity. Okay? In such a situation, we say if the absolute advantage is more in one commodity as compared to other commodity, we say the country has comparative advantage in that commodity. To make it clear, let me look at this modified example, which again I have taken from here. Instead of 1 and 5, now it is 1 and 2. At this 1 and 2 makes a picture. It changes the picture in a big way. Earlier, now this 6 to 1 is the same. country A has a competitive advantage in wheat, because while country B can produce only 1 unit of wheat in 1 hour, country B can produce 6. Country A has absolute advantage in wheat. Earlier, country B was producing 5 units of wheat cloth against 4 units of A. So country B had absolute advantage in cloth. Now, country B is producing only 2 units of cloth. Country B is producing 4. A is producing 4. So country A has absolute advantage in both the commodities. But the extent of absolute advantage is different. Here it is 6 times. Country A is 6 times as productive as compared to country B. Here it is only twice as much productive as compared to country B. That means the comparative absolute advantage is more in for the absolute advantage for country A is more in wheat and less in cloth. This is what we mean by saying that A has comparative advantage in wheat. So comparative advantage means absolute advantage is greater. In that case, we say there is absolute comparative advantage. So according to David Ricardo, who gave this theory of absolute comparative advantage, country A should produce commodity wheat in which it has comparative advantage. And if country A has comparative advantage in commodity A, then automatically country B will have comparative advantage in commodity B. So country A should produce wheat, country B should produce cloth. And that will still lead to gainful exchange between the two. Please note, if this trade is gainful to the two countries, then this goes against what mercantilism said. Mercantilism said if one country is gaining from trade, the other country will definitely lose. But we have seen in the example that we discussed about absolute advantage that both the countries are gaining. So that means it is not that only one country gains. Trade is not a zero-sum game. Both the countries stand to gain from trade. That is the idea that Adam Smith propounded. And here we will see now that even if one country has absolute advantage in both the commodities, still both the countries can gain. Using the same thing that we did earlier, look at this picture. 6 to 4, again, in this case, 6 is equivalent to 4 for country A and 6 is equivalent to 12 for country B. So as long as the exchange is between 4 and 12 against 6 units of wheat, it will be advantageous to both the countries. Let us see. Suppose again 6 to 6 ratio. 6 units of wheat, 1 hour for country A. 6 units of cloth, 1.5 hour for country A. Okay. So by exchanging 1 hour worth of wheat for 1.5 hour worth of cloth, country A is gaining half an hour worth of cloth. So it is saving country A half an hour worth of cloth. Okay, half an hour of labor. Look at country B now. 6 units of cloth is equivalent to 3 hours of work, 3 hours of labor. In 3 hours of labor, its own labor can produce only 3 units of cloth, of wheat. But through trade, it is getting 6 hours worth of wheat. So that is a gain of 3 hours worth of wheat. Okay, so country A is gaining cloth equivalent to half an hour. Country B is gaining wheat worth 3 hours of labor. Okay, both the countries are gaining. Okay, let's look at another ratio, 6 to 10 ratio. 10. Our country A is producing 4 units of cloth in 1 hour. So 10 units of cloth will be produced in 2.5 hours in country A. If it is getting 10 yards of cloth against 6 bushels of wheat, it means it is getting 2.5 hours worth of cloth against 1 hour worth of wheat. That means it's a gain of 1.5 hour worth of cloth for country A. Okay. On the other hand, look at country B. Country B is producing 2 yards of cloth in 1 hour. So this 10 hours, this 10 yards of cloth will be produced in 5 hours. Against 5 hours of cloth, it is again in return for that, it is getting 6 units of wheat, which would be produced in 6 hours in this country. Again, in just 5 hours, against just 5 hours worth of cloth, it is getting 6 hours worth of wheat. Still a gain of 1 hour's worth of wheat, saving of 1 hour of labor. Okay, again this leads to gain for both the countries. As long as this trade is between this, it is that 6 hours of wheat is being traded between against somewhere between 4 to 12 units of cloth, the trade will be gainful to the two countries. And the closer is this amount of cloth is to 4, more gainful it will be to country B. We have seen here the gain to country B is 3 hours worth of wheat. Okay, and for A it is only half an hour worth of cloth. And the closer it is to 12, more gainful it will be to country A. We have seen in this case it is 10. Gain of country A is 1.5 hours worth of cloth, but gain to country B is only 1 hour worth of wheat. Okay, so this is about theory of comparative advantage. One problem with the theories of David Ricardo and Adam Smith was that they just talk in terms of labor, because they believed in the labor theory of value. It is labor which creates value. Okay, Haberler extended the theory of David Ricardo to talk in general about factors of production, talk in terms general about the cost, and he used the concept of opportunity cost. Opportunity cost. I hope you understand what opportunity cost is. Opportunity cost of commodity A against of some commodity. Suppose I am concerned with the pens and dusters. Opportunity cost of pen, of opportunity cost of a duster in terms of pen is the number of dusters that can be produced, that the number of pens against which is equivalent to the number of dusters. Okay, so opportunity cost is this is what opportunity cost measures. It is about, if it were to be put to an alternative use, I have one duster which can be produced, and then there are pens which can be produced. If I'm measuring opportunity cost of duster in terms of pens, it means how many pens can I produce in the same set of resources which are required in order to produce 1 unit of duster. That's the idea of it. Okay. Theory of comparative advantage can also be understood in the concept in the terms of opportunity cost, and that can be done in the following way. Thank you for the question. No questions? We have seen this table so far in terms of productivity of labor. Okay, now let's talk in terms of cost in terms of labor. How many units of labor are required to produce 1 unit of commodity in each country? So we have seen that 1 unit of labor can produce 6 units of wheat. So for producing 1 unit of wheat, we need 0.16 units of labor in country A and 1 unit in country B, because there it was 1. 1 unit of labor can produce 4 yards of wheat of cloth in country A. So in 1 hour they can produce 0.5. For producing 1 yard of cloth, country A requires 0.25 hours of labor. Okay. On the other hand, in country B, in 1 hour they can produce only 2 yards of cloth, and therefore in order to produce 1 yard of cloth, they need 0.5 units of labor. Now we can calculate the opportunity cost. According to Haberler, comparative advantage means that a commodity should be produced in that country where the opportunity cost is lower. Let's look at opportunity cost in terms of cloth. Look at this. For producing 1 yard of cloth, you need 0.25 units of labor, 0.25 hours of labor. While for producing 1 bushel, you need 0.16 hours. It should be clear that means if 1 cloth can be produced, 1 bushel of wheat can be produced only in 0.16, it is 1/6 hours of cloth, hours, and 1 hour of cloth requires 0.25 units. So this is just about 1.5 times this, which is precisely what is written here. So if you want to produce cloth in country A, you will have to keep aside resources required to produce 1.5 units of wheat. In country B, requirement for cloth is 0.5 and requirement for wheat is 1. So you can produce only half an hour units of wheat, units of cloth. Okay. So in terms of cloth, the amount of resources which are required to produce 1 unit of cloth, that can produce only half an hour, half a unit of wheat in country A. That means another way to interpret this is the amount of weight that you will have to forego to produce 1 unit of cloth is 1.5 in country A, but only 0.5 in country B. Okay. On the other, so in that case, since the opportunity cost in terms of cloth, wheat, opportunity cost of producing cloth in terms of wheat is less in country B has comparative advantage in cloth, and accordingly, if country B has a comparative advantage in production of cloth, then country A has comparative advantage in the production of the other commodity, namely wheat. In order to explain the concept of opportunity cost again, let me now talk about it in terms of wheat. Opportunity cost of wheat in terms of cloth. That means the amount of units of cloth that one will have to forego in order to produce 1 unit of wheat. So let me write it explicitly. W. Let me write it here. Number of units of cloth that will have to be foregone in terms of to produce 1 unit of W, which is equal to cost of W divided by of cloth. Okay. Here, look at this. 1 unit of cloth requires 0.25 units of 0.25 hours, but 1 unit of wheat requires only 0.16 hours. This is just 2/3 of this. So in order to produce 1 unit of wheat, you just need to sacrifice 2/3 units of yards of cloth in country A. Look at country B. Wheat requires 1 hour of labor. Okay, but cloth requires only half an hour of labor. So if you are producing using the same resources which you would have used to produce cloth, if you are using those resources to produce wheat, you will have to forego 2 yards of cloth in country B. Okay, so to produce 1 unit of wheat in country A, you just have to sacrifice 2/3 unit of wheat cloth in country A, but in country B, you have to forego 2 units of cloth. Okay, opportunity cost of wheat is more in country B, less in country A. Opportunity cost is less in country of wheat is less in country A. Country A has absolute comparative advantage in terms of wheat. Yeah, for wheat, it should produce country A. So Haberler and David Ricardo both are talking about comparative advantage. It is just that David Ricardo is talking in terms of labor. Both David Adam Smith and David Ricardo talked in terms of labor. Haberler talked in terms of opportunity cost. Okay, so of course he talked. It could involve any number of factors of production. Of course he talked about capital and labor, but opportunity cost, on the basis of opportunity cost, which is the concept that Haberler used, one can talk in terms of advantages of trade in terms for any commodities, not just the commodities which are produced only using labor. That is the basic idea. Okay. The problem with these theories is that even though these explain the gains from trade, they do not explain you why comparative advantage arises. Another theory we have seen David Ricardo. And to this, Haberler added the concept of opportunity cost. The question is, why comparative advantage? The theory of comparative advantage, whether it is given by Haberler or David Ricardo, does not have any answer to this question. Answer to this question was sought by Heckscher and Ohlin. Paul Samuelson had also given some ideas for this, so it is also called Heckscher-Ohlin theorem. He says factor endowments play an important role in this. Assume that the two countries that you are considering both have same production function, same preferences of individuals, but they differ in terms of the factor endowments, the factors, the access to factors that they have. Assume that. So, for instance, one country could be rich in capital, other country could be rich in labor. So, for instance, India is a labor abundant country. Okay, and labor is in more abundance as compared to other factors of production. According to Heckscher-Ohlin theorem, this comparative advantage arises due to the presence of, due to the differences in factor endowments. Okay, we have talked about the commodity being produced in one country, cheaper, one commodity being produced at lower factor, lower cost in one country, and the other commodity being produced at lower cost in the other country. We have seen that. And the question that we are asking is, why is it so? Heckscher-Ohlin theorem says that the answer lies in the factor endowments. And the idea is the following. The country A, suppose there are two commodities. One commodity is, which is that one commodity is more labor intensive, other commodity is more capital intensive. Okay. A country in which there is abundant supply of labor, the price of labor will be low in that country. Okay, and accordingly, since it is capital scarce, the price of capital will be high in that country. We have assumed that both the technologies is the same in two countries. Okay, so when they are producing the commodities, they will be using the same quantities of factors of production in the two countries. The combination of factors of production will be the same in the two countries. Okay, but same the country in which labor is cheaper, it will be able to produce at lower cost that commodity which is labor intensive, which requires more labor. And the country in which capital is abundant and therefore the price of capital, cost of capital is low, that country will be able to produce at lower cost that commodity which is capital intensive. Okay, so according to Heckscher-Ohlin theorem, the trade becomes gainful, the countries have comparative advantage in one commodity versus the other due to differences in the factor endowments. Okay, a country tends to specialize in the export of that commodity whose production requires intensive use of its abundant resources, and accordingly, it will import that commodity which makes intensive use of that resource which is scarce in this country. So the country which is which is more heavily endowed with labor will tend to export the commodity which is labor intensive, and it will import the commodity which is capital intensive. The other country which is capital abundant country will tend to export the commodity which makes heavy use of capital, and which will import the commodity which makes extensive heavy use of labor. That is the basic idea. Okay, there is another theory which follows directly from the Heckscher-Ohlin theorem. This is called factor price equalization theorem. Factor price equalization theorem. We have seen that a country which has labor in abundance will tend to produce that commodity which is labor intensive, and the country which is abundant in capital will tend to produce that commodity which makes intensive use of capital. What will happen as a result? Just think for a while. Country A, which has labor in abundance and therefore the price of capital and the price of labor is low in that country, is producing a commodity which makes heavy use of labor. As a result of this, the demand for capital labor will be high in that country and demand for capital will be low. As a result, the price of labor will rise and price of capital will decline. On the other hand, the country which is capital rich and therefore which has low price of capital and high price of labor comparatively, that country is producing and exporting the commodity which is intensive in use of capital. As a result, the demand for capital in that country will rise, which will lead to rise in the price of capital. On the other hand, the price of labor will decline. Okay. As a result of this, the prices of the two factors will tend to equalize in the two countries. Trade will equalize the price of goods. Okay, because the commodity which would have been produced at a higher cost in this country, since it is being imported from abroad, its price will be lower because it is the commodity is being imported from abroad, because as we have seen, it is much cheaper to import it from abroad than produce at home. Therefore, its price will be lower as a result of trade. According to Heckscher-Ohlin, the factor price equalization theorem, as a result of international trade, the price of factors also tend to be equalized. Okay, so I hope this is clear. So according to this theory, then the trade in factors and trade in goods are perfect substitutes to each other. Okay, I'll fix this discussion here. Let me move to the idea of restrictions to trade. The theory that we have discussed so far would suggest very clearly that it is mutually gainful to for both the countries to engage in international trade. International trade is not a zero-sum game. It is generally beneficial to both the countries. Despite this, there are several reasons why countries would want to restrict the flows of trade. And to restrict the flows of the trade flows, they use in order to restrict the flow of trade, these countries tend to use several types of instruments. Now these instruments, why the countries engage in trade restrictions, I'll not go into details of that. You can read it directly from your book. But we discuss between tariff and non-tariff measures. Tariffs are in the form of taxes. on imports. Okay, and this taxes could be specific in the sense that these are levied per unit of commodity being imported, or it can be in terms of value of the import, which is called the ad valorem tariff. But the point is, tariff is in terms of tax. On the other hand, we have non-tax measures, which are various of different types, which are discussed again. It's just descriptive, so you can read from your book. I will not go into details of that. The other thing is trade negotiations. Let me talk in 2 minutes about trade negotiation. In the period between the First World War and the Second World War, the world economies faced major problems. Okay, we faced the Great Depression due to a sequence of events which I cannot discuss here due to paucity of time. The trade between countries suffered major drawbacks. Okay, capital flows suffered major drawbacks. Countries had major balance of payment problems. So efforts were made towards the end of the Second World War to have an international body which would provide assistance to the countries in reconstructing their economies after the devastation caused by wars, and also because some countries were already poor. B, there was a body to supervise the working of the international monetary system. And C, they tried to establish a body to supervise international trade so that it could promote international trade. Of course, they were able to establish the bodies to provide aid to countries to reconstruct their economies, which is called the World Bank, and a body to supervise the international monetary system, which is called the International Monetary Fund. They were not able to establish a body for supervision of international trade, but they were able to have body at a general agreement that was called the General Agreement on Trade and Tariff, GATT. Under the General Agreement on Trade and Tariff, several rounds of negotiations were held between countries to gradually reduce the barriers to free trade among countries. Okay, and a lot of progress was made over roughly close to 5 decades between 1946-47 and 1995. And in 1995, the organization which was to be established to promote international trade among countries, that organization was finally established. That organization is called World Trade Organization, WTO. The chapter number unit 3 in your book gives details of trade negotiations that happened under the GATT and its process of culminating establishment of WTO, what has been achieved under GATT and WTO so far, and what are the major areas of concern as of today. These are descriptive in nature, so I will not go into that. I will instead move to the chapter on exchange rates. Okay, let me spend a few minutes discussing exchange rates. Let me clarify here that when we talk about open economy, we talk about trade in 2 types of things. We talk about trade in goods and services, and we talk about trade in assets, financial assets. Financial assets, this is covered under the topic of capital flows. In finance, you studied that if I am buying assets from you, your financial assets, that means I am lending to you. Okay, so capital is flowing from me to you. So similarly, if some US citizen is buying Indian financial assets, okay, the capital of that US citizen national is coming to India. So then purchase of US national purchase of Indian assets by US national leads to outflow of capital, inflow of capital, and similarly purchase of US assets by Indian individuals leads to outflow of capital. So trade in financial assets leads to capital flows. These capital flows are mainly categorized into 2 types of flows: foreign direct investment and foreign portfolio investment. Foreign direct investment gives you some type of ownership rights over the firm whose financial assets you are buying. Okay, foreign portfolio investment does not give you any such entitlement because it is just for financial gains. Okay, but this is so, and that is the reason the portfolio investment portfolio flows are regarded as more volatile because you don't have ownership claims that much. So you can simply, take in and take out very easily. So for foreign direct investment since it has some type of ownership type of claims, major ownership type of claims, one would not like to take the money out that easily. On the other hand, since you have major stake in the firm, you would make efforts to promote the growth of that particular company by maybe bringing in more technology, more expertise from abroad. So that is the reason foreign direct investment is treated as better in many ways as compared to foreign portfolio investment. These issues are discussed at length in the last topic of this unit. You can read on your own. I have provided a summary. Last few minutes that are left in this lecture, I would like to discuss on the exchange rates. I had tried to spend time on those things which required explanation and the things which are mostly descriptive in nature and doesn't require much explanation. I have focused less on those topics. Exchange rates. Exchange rate. Exchange rate is a price of in terms of domestic currency. So for instance, today, in order to buy $1 you require 76 rupees. Then you say rupee dollar exchange rate is 76 rupees. Indian rupees 76 per USD. This is called the direct quote, in which you are expressing in terms of number of domestic currency, number of units of domestic currency required in order to purchase 1 unit of foreign currency. The other is called indirect quote. This is the reciprocal of this. It gives you number of units of foreign currency required to buy 1 unit of domestic currency. It should be clear, it will be 1 by 76 in this case. So that is the idea of exchange rate. Exchange rate regimes, exchange rate can be fixed or flexible or some type of hybrid arrangement. In case of fixed exchange rate regime, central bank is committed to maintaining the parity value. So suppose, for the sake of example, suppose the exchange rate of rupee against dollar is fixed at rupees 75. In that case, central bank has to maintain that. How? Suppose there is excess demand for foreign currency. Okay, in the market, if there is excess demand for US dollar, the price of dollar will tend to rise. In order to prevent the exchange rate from rising, central bank intervenes and supplies the extra dollars. Okay. Similarly, when there is excess supply for dollars, the price of dollar will tend to decline below 75. Okay. If the central bank is committed to maintaining fixed exchange rate, it will intervene in the market by buying those extra dollars. So fixed exchange rate requires the central bank has to be in the foreign exchange market. One important macroeconomic consequence of this is when Reserve Bank is buying dollars from market, it is in turn, when it is buying dollars, in turn it is giving Indian rupees. Okay, and when it is selling dollars, it is buying Indian rupees. So in that case, the domestic money supply changes. In response to such interventions in the market. Okay. In case of flexible exchange rate regime, market determined completely. So in that case, Reserve Bank doesn't have to intervene in the market. If there is excess demand for dollars, the price of currency will rise. Excess supply of the dollar, price of dollar will decline. Reserve Bank doesn't intervene at all. Okay. Hybrid, it could be mostly the countries follow hybrid exchange rate systems. Most of the countries these days. Hybrid means it is somewhere between completely fixed and completely flexible. One example of this exchange rate band. You give a parity value, say 75, and then you give a band of plus minus say 1%. So 1% means 1% above 75, 1% below 75. So as long as it is fluctuating between 1% of 75 means 75 paise. So as long as it is fluctuating between 75.75 and 74.25, central bank doesn't intervene. To that extent, it allows the currency to fluctuate. If it crosses those two boundaries, then Reserve Bank intervenes. So it is one system. Other is called managed float. Managed float means central bank intervenes in the market when there is excess volatility. If the exchange rate is, so suppose there are currencies appreciating in a big way, central bank will absorb a part of the gap. Okay, so suppose there is excess demand for domestic currency. As a result, excess demand for foreign currency. As a result, the price of foreign currency is rising. Central bank in fixed exchange rate regime would have absorbed the entire excess demand for foreign currency. Would have given the entire excess demand amount of foreign currency equivalent to entire excess demand. In case of hybrid managed float, central bank will just give a part of that. So fluctuations in the exchange rate would be reduced to some extent. The idea in the managed floating exchange rate system is the long run level of exchange rate central bank is not affecting. It is just controlling the excess fluctations. That is the idea of managed float. Managed float and banks are just two of the several hybrid exchange rate systems which are discussed at length in table 4.4.1 in your book. Okay, the two other terms, set of terms that are useful for you at this stage are appreciation and revaluation. And appreciation of domestic currency this appreciation and depreciation are used in case of flexible exchange rate system. Flexible exchange rate system. And devaluation are used in case of fixed exchange rate system. Appreciation means the value of domestic currency has risen. A value of domestic currency has risen, that means the price of foreign currency in terms of domestic currency has declined. If the exchange rate, this E, this is how it is expressed in terms of there is number of units of domestic currency required to buy a unit of foreign currency. If this declines, it is appreciation. If it is rises, it is called revaluation and devaluation are the corresponding terms, but in fixed exchange rate regimes, and these are carried out by the central bank. So appreciation, depreciation happens in the market. Central bank doesn't have anything to do with it. Revaluation, devaluation happens to the central bank. So it's through the intervention of central bank. E is reduced, it is devaluation, or if E is raised, it is said to be devaluation. India, for instance, devalued its currency twice in the first week of July 1991. And prior to that, it had done it in a major way in 1966. Okay, that is the idea of devaluation. As far as depreciation is concerned, you must have seen during last month or so, it has come within a span of about 3-4 months, it has come from roughly 71 to 76. So depreciation of more than 7-8%. Within a span of 3-4 months. Okay, so this is depreciation. The other important concept is that of nominal exchange rate versus real exchange rate. The nominal exchange rate is number of units of foreign domestic currency required to buy 1 unit of foreign currency. A real exchange rate is in terms of units of commodity. Now this requires some understanding. I'll just take 2 minutes to explain this, but it is important for you to understand. Suppose country A Suppose US is producing commodity A and India is producing commodity B. Okay. Question is of units of B required to buy 1 unit of A. Think about it carefully. Number of units of B required to buy 1 unit of A. Suppose US is producing only one commodity, which we call A. India is producing only one commodity, which we call B. Question is, how many units of B are required to buy 1 unit of commodity A? Now, suppose the price of that in the US is, let me call it PA. PA is the price in US dollars. If you want to convert it to Indian rupees, you will require E per unit of E. So suppose it is $10 and rupee dollar exchange rate is 50. So in terms of Indian rupees, it would be 750 rupees. Okay. The price of B in India is suppose 75 rupees. Suppose. So you will have to divide it. So in 750 rupees, you can buy 10 units of B. So that means in order to buy 1 unit of commodity A, you need to have P this much. This many units of commodity A. So this is the idea of real exchange rate. So this is simply the nominal exchange rate multiplied by price of foreign commodity divided by price of domestic commodity. I have talked in terms of one commodity, but in general countries produce more than one commodity. In this case, we talk about price level. So we say real exchange rate is nominal exchange rate. Let me, instead of A and B, let me now talk about US foreign country and domestic country, foreign economy and foreign price level, domestic price level. This is called the real exchange rate. The reason I highlighted this here is very important. This tells you the ratio, the relative price of foreign goods vis-a-vis domestic goods. Suppose this PF is very high. This PF is say $10. In order to buy this and E is this. So in terms of rupees, in order to buy this US commodity, you need PF into E rupees. In order to buy Indian commodity, you need just PD. If this ratio is high, that means this foreign commodity is more expensive as compared to Indian commodity. In that case, you will buy more of Indian commodity than the foreign commodity. That means it will lead to lower imports. Similarly, foreign nationals will buy more of Indian goods than the foreign goods. So, let me call it Z, real exchange rate. This is called the real exchange rate. As real exchange rate rises, more expensive therefore exports imports decline, therefore net exports rise. That is the significance of real exchange rate. How is exchange rate determined? Exchange rate is determined again by the demand and supply forces. If demand for foreign exchange is higher, then the exchange rate will depreciate. Why will demand for foreign exchanges will be higher? When do we need foreign exchange? A, we are importing from abroad. If imports are more, currency will depreciate. B, people are buying foreign currency because they want to take capital abroad. Okay, that means capital is flying out. So when there are outflows, it will lead to currency depreciation. So that means currency depreciation will happen when either imports are more or capital is flowing out. This standard demand supply curve, demand curve is downward sloping, supply curve is upward sloping. More demand, that means demand curve shifts to the right, the price rises. Price is simply the exchange rate. And when supply is more, then that means we are exporting more or there are capital inflows. In that case, supply curve will shift to the right. As a result, price will decline. So the price of domestic foreign currency will decline. That means Indian rupee will become stronger. For the last few days, you must have seen in particular after the onset of this pandemic, we have witnessed capital outflows. Okay, and as a result of that, currency has depreciated. Okay. I think this is where I will stop. To finish the lecture, I will very quickly do a couple of numerical questions from your book, from national income content, because there was a demand yesterday that I should do a couple of numerical questions from national income accounting. Let me take, for instance, this is question number 1 from your book. I'll just read out the question. It says, compute national income, consumption, investment, government purchases, exports and imports are given. So C is equal to 750, G is equal, I is equal to 250, G is equal to 100, exports is equal to 100, and imports is equal to 200. So from this it should be clear that Y is equal to C plus I plus G plus X minus M is equal to 750 plus 250 plus 100 plus 100 minus 200, which is equal to 1000. I'll just do one more question. Question number 2 from the same. It says inventory investment. Now look at the entries here. It says inventory investment 100, exports 200, indirect taxes 100, net factory income from abroad minus 50, personal consumption expenditure is 3500, gross residential construction investment is 300, depreciation 50, imports, and this you can read this question number 2 at page 1.28 in your book. It says first calculate GDP MP and derive the national income. First let me calculate GDP MP. GDP at MP is equal to C plus I plus G as I have calculated abroad. Now when this consumption is given to be equal to personal consumption expenditure is 3500. Investment, there are 3 components given here. One is inventory investment is equal to 100, plus then there is gross residential construction investment is given to be equal to 300 rupees, and then there is gross public investment, government investment is 200 rupees, and then gross business fixed investment is 300 rupees. So investment comes out to be equal to how much? 100, 200, 300, 300. So this comes out to be equal to 900 rupees. Then government expenditure is government purchase of goods and services given to be 1000. Exports are given to be equal to 200. Imports are given to be equal to 100. So GDP this will be equal to 3500 plus 900 plus 1000 plus 200 minus 100. This you can calculate. It will give you some value. It will be, I think, 5500. Then we are supposed to calculate national income from this. We know national income is equal to NNP FC. NNP to FC means from GDP at market price. First we need to convert it into factor cost. For factor cost we need to subtract net indirect taxes. That will give me factor cost. Then I need to convert into net. That means I need to subtract depreciation, and then I need to add NFIA. Okay, to convert into net national product, which is one net factor. This is, which means it will be equal to GDP at market price is 5,500. Then net indirect taxes, it says indirect taxes are 100 and subsidies are not given. The subsidies are not given here, so that means we need to assume them to be equal to 0. So net indirect taxes is 100. Then depreciation is 50. And net factoring income from property is minus 50. Which gives me I hope this is fine. I have taken 2 numerical examples and I think it's already well 9:15. So I think I'll have to stop here. If there's any major question. Several questions. I'll just take one major question here, which I think will be important to all of you. Well, IMF classifications are important because there are several types of exchange rate regimes which differ to each other in minor way. You should understand the differences among them. And vehicle currency is the currency. Dollar is these days the vehicle currency. Vehicle currency is the currency in which trade takes place even among the countries where it is not where this particular country is not involved. So, for instance, even in the if US is not a trading partner in some deal, the transactions still take place in dollar these days. Okay, the exchange rate for all the currencies are discussed in terms of quoted in terms of US dollar. So US dollar is the vehicle currency. All other exchange rates are cross exchange rates. So suppose you are talking about exchange rate between Indian rupee versus Japanese yen. So you will talk in terms of Indian versus rupee versus dollar, Japanese yen versus dollar. And from that you will derive the exchange rate. Dollar is the vehicle currency. Trade is taking place between India and Japan, but the prices are being quoted in terms of dollar because dollar is the vehicle currency. I can just take questions which can be answered in such a short time frame that we have here. Foreign portfolio investment, foreign institutional investment are not the same thing. Foreign institutional investment is just buying shares or bonds of the company, even if in a small magnitude. Foreign direct investment is a major share. These days it is at least 10% share in the firm as per the standard criteria accepted. I think I'll stop here. So anyway, so I think this is where I'll stop. I hope I was able to explain you the major concepts. Of course, given the positive time, it was not possible to cover everything. So I have tried to focus on the topics which require explanation and the topics which can be read from the book without much difficulty, without any, those I have tried to sort of, I have not put that much emphasis on them so that I can lay more emphasis on the topics which are rigorous. I hope my lectures were helpful. So thank you for listening to lectures patiently. Thank you.